You keep hearing that you need to save for your future and invest to build wealth. And you might be thinking, aren't they the same thing? What if I told you that confusing these two is one of the biggest financial mistakes you can make? That by putting your money in the wrong pot, you could be leaving thousands, even hundreds of thousands of dollars on the table, or worse, putting your financial security at risk. Welcome back, everyone. Today, we're breaking down the crucial difference between saving and investing. This isn't just jargon, it's the foundation of every solid financial plan. And here's the spoiler: you don't have to choose. You need to do both, but you need to know when and why. By the end of this video, you'll know exactly where to put your next dollar. Let's start with saving. Think of saving as your financial life jacket. Its two main jobs are security and liquidity. Security means your money is safe. The amount you put in is the amount you can expect to have when you need it. Liquidity means you can get to it quickly, easily, and without penalty. This is your break glass in case of emergency money. So, where do you save? In places like a high-yield savings account, a money market account, or certificates of deposit, or CDs. The purpose of saving is your financial safety net. This is your emergency fund for things like a sudden job loss, a car repair, or a medical bill. It's also for short-term goals you have within the next 1 to 3 years, like saving for a vacation, a wedding, or a down payment on a car. Now, here's the trade-off. The safety of saving comes with a cost: minimal growth. The interest rates on most savings accounts often don't keep up with inflation. That means the purchasing power of your money can actually shrink over time. Your $100 today might only buy $98 worth of groceries next year. Saving is about protection, not growth. Now let's talk about investing. If saving is your life jacket, investing is your rocket ship. The goal here isn't safety, it's growth. You are putting your money to work, accepting some risk for the potential of a much higher return. Risk means the value of your investments can go up and down. Your statement won't always be green, and that's normal. The return is your reward for taking that smart, long-term risk. You invest in things like stocks, owning a tiny piece of a company, bonds, loaning money to a company or government, ETFs or mutual funds, buying a whole basket of stocks or bonds at once, or real estate. The purpose of investing is to build long-term wealth for goals 5, 10, 20, or even 40 years away. And this is where the magic happens. Compound interest. It's when your earnings start generating their own earnings. It's a snowball effect that, over decades, can turn regular contributions into a massive nest egg. It's the most powerful force in investing, and it needs time to work. So, to make it crystal clear, saving is for your short-term safety with low risk and low return. Investing is for your long-term growth with higher risk and higher potential return. They are fundamentally different tools for different jobs. So, to make it crystal clear, saving is for your short-term safety with low risk and low return. Investing is for your long-term growth with higher risk and higher potential return. They are fundamentally different tools for different jobs. Okay, so now the big question: what do you do with this information? You don't pick one. You build your financial future in a specific order. Step 1. Build your foundation. Before you even think about stocks, build your emergency fund. Aim for 3 to 6 months of essential living expenses in a savings account. This is your financial airbag. It's what lets you be a calm, long-term investor when life gets crazy. Step 2. Slay your debt. If you have high-interest debt, like credit cards, focus on paying that down next. Getting a guaranteed 20% return by eliminating credit card interest is often better than any stock market return you can find. Step 3. Launch your rocket. Once your safety net is secure and your toxic debt is gone, you can now confidently start investing for the long term. Open a retirement account like a 401k or an IRA, set up automatic contributions, and let time and compound interest do the heavy lifting. So, to recap, saving and investing aren't rivals. They are a team. Saving provides the stability to handle the present, and investing provides the power to build your future. Stop stressing about choosing one. Secure your foundation with savings, and then build your empire with investing. If this video helped clarify things for you, please give it a thumbs up. It really helps the channel. Now I want to hear from you. What's your biggest financial goal right now? A short-term one you're saving for, or a long-term one you're investing for? Let me know in the comments below. Don't forget to subscribe for more simple guides to mastering your money. Thanks for watching, and I'll see you in the next one.